Welcome back to the deep dive. Every year, it feels like September brings a certain chill to the financial markets, doesn't it?
It definitely does. That September effect is pretty well known.
Yeah, and you've probably heard the common theories like, portfolio managers coming back from summer vacation, maybe just seasonal superstition.
Right, the standard explanations.
But today, we're going beyond those surface-level ideas. We want to uncover the surprising liquidity dynamics that might really be driving this whole thing. Okay, let's unpack this.
Sounds good, because it's often about the money flow.
Exactly. Our mission is to understand how that flow of money, liquidity, might be the unseen, hand-guiding market movements, especially in September. We're digging into a really insightful source today. Market rhymes the September effect through the lens of liquidity from EvergreenVistas. And this core idea, it's perfectly captured by Stanley Druckenmiller. He said, earnings don't move the overall market, it's the Federal Reserve Board. Focus on the movement of liquidity. Most people look at earnings and conventional measures. It's liquidity that moves markets. Powerful stuff.
It really is. Druckenmiller's point, well, it challenges so much conventional wisdom, doesn't it?
Totally.
We're always pushed to look at earnings or GDP or, the latest geopolitical headline.
Right, the obvious things.
And those matter. Of course they do. But they often miss this deeper, more fundamental pulse, liquidity.
The hidden plumbing.
Exactly. And understanding why it matters and how it flows, well, that gives you, our listener, a significant advantage. It helps you cut through the noise.
That's the perfect setup. So to really get this, we have to start with the foundational plumbing, like you said, the Federal Reserve's balance sheet. It sounds maybe a bit technical, I know, but trust me, this is where the action really happens. So what are the key pieces of this balance sheet we need to grasp to see where the money's actually flowing?
All right, let's break it down, because these components directly control how money moves in and out. First up, you've got SOMA. That's the System Open Market Account.
Okay, SOMA.
Think of these as the assets the Fed holds: T-bills, bonds, mortgage-backed securities that it buys or sells.
Right.
When the Fed buys assets, that's quantitative easing, QE, it injects liquidity, pushes cash out there.
Injecting cash, got it.
And when they let those bonds mature, roll off the balance sheet, that's quantitative tightening, QT, that drains liquidity.
Okay, drains it.
Now, the Fed is doing QT right now, but honestly, at about $5 billion a month. It's kind of negligible in the grand scheme of things for this specific discussion. A pretty minor factor.
Hey, so not the main player right now. What's next?
Next is the RRP, the Reverse Repo Facility.
RRP, heard a lot about that one.
Yeah, you probably have. Imagine it like a temporary parking lot for cash. The Fed uses it to absorb to excess liquidity from the system.
Absorbing it? How?
They sell securities to institutions, mostly money market funds, and agree to buy them back later. It mops up cash.
Oh.
And this thing was absolutely massive. In late 2022, it peaked at $2.5 trillion.
$2.5 trillion, wow.
Enormous, right. More than the GDP of some decent-sized countries.
Yeah.
But here's the kicker. As of last week, it's down to about $35 billion.
$35 billion from $2.5 trillion. That's a huge drop.
Huge, dramatic,
Yeah.
and really, really important for what's happening now. Keep that number in mind.
Okay, will do. What else is on the balance sheet?
Then you have the TGA, the Treasury General Account.
The government's checking account, basically.
Exactly. That's a great way to put it. It's the U.S. government's main account at the Fed.
Right.
Now, when the Treasury spends more than it takes through issuing debt, cash flows out of the TGA and into the economy. That injects liquidity.
Okay, spending equals injection.
Yep. But conversely, when the Treasury issues their debt or collects more in taxes than it spends, money flows into the TGA.
Pulling money out of the system.
Exactly. Draining liquidity from the financial system. Its average balance is usually around, say, $800 billion.
$800 billion. Got it. One more.
Last key one for us, bank reserves. These are simply the deposits that commercial banks hold at the Federal Reserve.
Okay. Banks cash at the Fed.
And they are absolutely central to system liquidity. If these reserves go down, banks have less cash to lend. That pushes short-term interest rates up.
Makes sense. Tighter money.
Right. And if reserves go up, there's more cash available, pushes those rates down. Easier money.
Okay, so let me quickly recap that for you listening. SOMA, Fed's assets, QE/QT. RRP, temporary cash parking, now nearly empty. TGA, government's account, spending injects, taxing borrowing drains. Bank reserves, Banks, cash at the Fed, crucial for lending.
That nails it. Those are the key levers and pools of cash.
It's a much clearer picture now of the players. Okay, so how do these pieces, especially the TGA, connect to this whole September effect pattern, particularly around debt limits?
This is where it gets really interesting, connecting those mechanics to the seasonal pattern. You mentioned debt limits. When the government hits its borrowing limit, the Treasury can't issue new debt.
Right, their hands are tied.
So to pay the bills, Social Security checks, government salaries, all that they have to spend down the cash they already have. Where is that cash?
In the TGA.
Exactly. So that TGA balance, normally around $800 billion, gets drawn down, sometimes close to zero.
Okay.
And remember what happens when cash leaves the TGA.
It injects liquidity into the economy.
Bingo. Our source calls it almost like $800 billion of stealth QE, but happening much faster, like twice the speed. Big cash injection.
Stealth QE, I like that. Okay, so the TGA drains, injecting cash. But then what?
Then Congress raises or suspends the debt limit. The crisis passes. But now the Treasury has an almost empty checking account.
Oh, they need to refill it.
They have to refill it.
Rapidly.
They issue a flood of new T-bills and bonds to get the TGA back up to that $800 billion target.
And issuing all that debt.
Drains liquidity. It pulls cash out of the system as investors buy those new bonds.
Okay, so drawdown, injects, rebuild, drains, and this happens cyclically.
We saw this exact pattern in late 2021, again in the first half of 2023.
And you're saying it's potentially happening again now in 2025.
Well, we're in the rebuild phase now. And this is where comparing 2022 and 2023 gives you that real aha moment.
Okay, tell me about the difference.
The 2022 TGA rebuild, after the late 21 debt ceiling fight, that acted as a major liquidity drain, a big withdrawal.
How so?
Remember that huge RRP balance back then?
Yeah.
Over $2 trillion.
Yeah, the massive parking lot.
Well, for various reasons, it wasn't tapped significantly to fund that TGA rebuild, so the money had to come from somewhere else.
Bank reserves.
Directly from bank reserves. It was a classic liquidity suck from the banking system. Bank reserves actually fell by $1 trillion.
$1 trillion. No wonder markets sold off then.
Exactly. Equities peaked around then, December 21, and the sell-off coincided with that reserve drain. Now, contrast that sharply with the 2023 TGA rebuild.
Okay, what happened differently in 23?
This was fascinating. The Treasury, under Secretary Yellen, did something clever. They manipulated, as the source puts it, their debt issuance.
Manipulated how?
Instead of issuing lots of long-term bonds, they heavily skewed the new debt towards short-term T-bills.
Okay, lots of short bills. Why did that matter?
Because they offered these T-bills at yields just slightly above the rate the Fed was paying on the RRP.
Ah, making them more attractive than the Fed's parking lot.
Precisely.
Yep.
So who was sitting on trillions in the RRP?
Money market funds.
Right. So these MMFs saw the higher yield and moved their cash out of the RRP and into the new T-bills.
Oh, I see. So the money to refill the TGA came from the RRP.
Exactly. It came predominantly from the RRP, not from bank reserves. This was crucial.
So it avoided draining the banking system like in 2022.
Correct. It was actually, you could argue, effectively stimulative because it didn't suck reserves out. It also reduced duration risk in the market, fewer long bonds, and prevented that crowding out effect where investors might have to sell stocks to buy treasuries.
Wow. So bank reserves didn't plummet in 23.
Largely went sideways, a completely different outcome than the $1 trillion drop in 2022. What's fascinating here is just how strategic that shift was.
That's a huge difference. So the method of refilling the TGA is just as important as the refilling itself. That's the key takeaway for you listening. But hang on a second. Could the Treasury just keep doing that? Always issue short-term bills to pull from the RRP and avoid hitting bank reserves. Is that sustainable?
That is an excellent question. The 2023 strategy worked because the RRP was so massive. It was this huge available pool of cash, over $2 trillion deep.
Right. They had somewhere to pull from without hitting the banks.
Exactly. But remember what the RRP balance is now.
You said about $35 billion, practically empty compared to before?
Precisely. So the ability to repeat that same maneuver to fund the TGA rebuild, primarily from the RRP, that's gone. The pool is dry.
Okay, that limitation makes perfect sense. Which brings us to right now. Given that history and the state of the RRP, where are we standing as we head deeper into September 2025?
Okay, let's look at the current numbers. The TGA is around $590 billion. Target is roughly $800 billion.
So it still needs, what, $250 billion?
About that, yeah. Another couple $100 billion need to flow in. Now, here's the critical part, building on what we just said. The RRP is nearing zero. It's only $35 billion.
Not enough to cover the remaining rebuild.
Not even close. So where must the money for this remaining TGA rebuild come from?
It has to be bank reserves.
It has to come from bank reserves.
No
There's
doubt.
no other major pool left. This means a direct drain on banking system liquidity is happening right now this September.
Okay, so unlike 2023, this TGA refill is pulling liquidity from the banks?
Yes, and this drain is being amplified by a couple of specific September calendar events.
Right. What else is happening?
First, September 15th.
Yes.
It's a major deadline for quarterly estimated tax payments. Corporations, individuals, they need cash to pay Uncle Sam.
Okay, tax day.
So entities sell assets or just pull cash from their accounts. That money leaves the banking system and flows straight into the TGA. So it reduces bank reserves directly, tightens financial conditions, and it can create selling pressure in stocks as people liquidate to raise cash. It's a double hit. Tax payments drain cash, and the TGA is still rebuilding.
A double drain. Ouch. What's the second factor?
Second is the U.S. federal fiscal year end. That's September 30th.
Right, the end of the government's financial year.
In the run-up to that deadline, the Treasury often increases its issuance of bills and notes to fund operations and manage cash flow into the new fiscal year.
More Treasury issuance.
Means more liquidity drain as investors shift cash into those new government securities competing for funds. Plus, you sometimes get volatility from government agencies shuffling their budgets around year-end. Big money moving.
Okay, so you've got the ongoing TGA rebuild hitting bank reserves because the RRP is empty. Then you layer on quarterly tax payments draining cash around the 15th. And then you add potential extra Treasury supply and budget shuffling into the 30th.
Exactly. You can see how all these pieces are converging. It creates this very specific, concentrated pressure point on liquidity right here in September.
It really does sound like a perfect storm brewing in the financial plumbing. But you mentioned earlier it's not just about liquidity, right? There are other things contributing.
Absolutely. Liquidity is, I think, the primary driver,
Yeah.
the big one. But other seasonal and structural factors definitely pile on and make September particularly weak.
Okay, what are those?
One is regulatory balance sheet adjustments. Think window dressing.
Ah, banks cleaning up their books for the quarter end.
Exactly. Especially September 30th, a major quarter end. Banks and dealers often temporarily shrink certain activities like repo lending or derivatives exposure to make their balance sheets look healthier, less risky for regulatory reports.
So they lend less, pull back a bit.
Right. This contraction in their lending capacity happens just as cash demand is peaking from tax payments and Treasury issuance. It amplifies funding stress.
So less credit available when demand is high.
That stress can spill over into equity markets. Now, let me be clear. We aren't forecasting like a repeat of the September 2019 repo crisis or anything that dramatic.
Okay.
But the mechanics suggest we could definitely feel some tightening of funding conditions, a bit more friction.
Got it. What else adds to the September pressure?
Another factor is the corporate earnings calendar lull. September is kind of a data vacuum for earnings.
Right. Q2 earnings are done. Q3 isn't out yet.
Exactly. Q2 season's behind us. Q3 results don't really start hitting until October. So without those fresh company-specific earnings catalysts.
Markets are more vulnerable to the bigger picture.
Precisely. More vulnerable to macro worries, market conditions, political noise, narratives. There's just less fundamental news to grab onto, leaving more room for these broader pressures to dominate.
Makes sense. Less company news means focus on the plumbing.
Yeah. And finally, there's a simple human element. Summer vacations end.
Everyone comes back to the office.
The real money comes back. Portfolio managers, institutional traders, they're back at their desks after August. Trading volume usually picks up.
And that's bad. More trading volume.
Not necessarily bad, but it changes the dynamic. Over the low-volume summer, you often get algorithms and maybe more retail activity driving some big moves, maybe pushing things out of whack.
Right. Summer rallies can feel a bit thin sometimes.
Well, now the real humans, the pros, are back. They scrutinize positions, valuations. Things that maybe ran up too far in the summer face a tougher audience. It can lead to rebalancing, position adjustments, just more volatility.
So putting it all together for you listening, the liquidity drain hitting bank reserves, amplified by taxes and fiscal year end, then layer on banks, maybe window dressing their balance sheets, a lack of earnings news, and the return of institutional traders scrutinizing summer moves.
It paints a pretty clear picture, doesn't it? A multifaceted vulnerability. It's not just one single thing. It's this confluence of factors hitting all at once.
Okay, so let's connect all these threads. Given this deep dive into liquidity, the TGARP story, these seasonal factors, what does this all mean for what we might expect watching the markets unfold this September 2025?
Well, based on everything we've discussed, particularly the liquidity analysis, we are definitely entering a vulnerable period. Liquidity is draining from the system via bank reserves.
Okay, vulnerable period.
It's also worth noting, the market isn't exactly sitting at all-time highs right now anyway. It's already shown some weakness.
True.
And our source points out that systematic funds seem stretched. Plus, retail investors, as the source colorfully puts it, have been punting zero DTE options all summer.
Ah, yes, the zero-day options, those super short-term bets, the buy-the-dip crowd fuel.
Yeah, the BTFD crowd loves them. They're high-risk, high-octane bets. So you've got stretched funds, maybe some speculative excess from the summer, meeting this tightening liquidity situation.
Sounds like a recipe for a pullback.
It points to a strong possibility of an overdue correction this September. It really reinforces that idea from the source title, Market Rhymes. These patterns tend to repeat when the underlying conditions align.
And are we seeing any signs already? We're just into September now.
Well, the source notes today is the first trading day in September. So this is as of yesterday, September 3rd, 2025.
Okay.
And on that day, both SPY and QQQ closed lower. The broad market indexes were down. Interestingly, retail favorite PLTR eked out a modest gain of 0.24%, buoyed by the ever-resilient BTFD crowd.
Huh, okay. So some dip buying resilience in favorites, but the broader market felt the pressure immediately.
Seems that way. The early signal aligns. Liquidity is tightening, and the September effect looks like it's in motion.
Wow, what an illuminating discussion. We've really gone beyond the usual narratives to see the complex interplay of liquidity, government funding, these seasonal behaviors that seem to really drive the September effect. It's not just some calendar quirk. It feels like a predictable confluence of forces, often hidden right there in the Fed's balance sheet data if you know where to look.
It often is.
Our hope is that by understanding these deeper mechanisms, you, listening, can cut through the noise. You can become truly well-informed, equipped with insights that go way beyond the daily headlines.
That's the goal.
So here's a thought to leave you with. If liquidity truly is this master key to market movements, how might that change the way you interpret daily headlines, or economic reports, or even company earnings announcements? Something to ponder as you watch things unfold this month. Thank you so much for joining us on this deep dive.
Yeah, it raises an important question, doesn't it? If liquidity is paramount, perhaps our focus needs to shift a bit from some of the conventional metrics. It's worth watching how these flows impact things in real time.